How some mortgage lenders are beginning to consider cryptocurrency to qualify borrowers. The rapid growth of cryptocurrency has created a new challenge and opportunity within the traditional mortgage system. Many buyers today hold significant wealth in digital assets, yet for years those assets could not be used to qualify for a mortgage unless they were sold and converted into cash. That landscape is beginning to change. Below is a clear, realistic explanation of how and why some lenders are now considering crypto holdings in mortgage qualification, explained from a realtor, lender, and investor standpoint. 1. Why mortgage underwriting is evolving. Historically, cryptocurrency was excluded from mortgage underwriting for three main reasons. Verification challenges. Mortgage underwriting relies on assets that are traceable, documented, and easily verified. Crypto initially lacked standardized reporting and regulatory clarity. Price, volatility. Unlike cash or traditional investments, crypto values can swing sharply, making lenders cautious about treating it as stable wealth. Regulatory uncertainty. Without clear guidance, lenders avoided integrating crypto into conservative risk models. That began to shift as exchanges became regulated, reporting improved, and institutional adoption increased. In 2025, the Federal Housing Finance Agency, FHFA, instructed Fannie Mae and Freddie Mac to begin developing frameworks for evaluating digital assets within borrower financial profiles. This does not mean universal acceptance, but it marks a meaningful structural change. 2. How crypto can be used in mortgage qualification. Today there are three primary ways some lenders are incorporating cryptocurrency into underwriting. A. Asset inclusion, reserves, or net worth. This is the most common and conservative approach. Some lenders allow crypto holdings to be included as assets, similar to stocks or investment accounts, without requiring liquidation. Crypto is not treated as income but strengthens the borrower's overall financial position. How this helps: satisfies reserve requirements, typically 6 to 12 months of housing payments, strengthens net worth, improves overall borrower profile, typical lender requirements, assets must be held on U.S. regulated exchanges, balances must be verifiable via statements or reporting tools, lenders apply a volatility haircut, often counting only 60–80% of the value assets, must be seasoned and stable. This approach is most common in jumbo, flexible, conventional, and non-QM loans. B. Crypto-backed mortgages. This model exists primarily in private and non-QM lending. Instead of selling crypto, borrowers pledge digital assets as collateral alongside the property. The crypto remains owned by the borrower but is locked or pledged during the loan term. Key characteristics: allows borrowers to preserve upside without liquidation, reduces reliance on traditional income documentation, appeals to high net worth and investor borrowers. Risks and considerations: sharp crypto price declines may trigger margin calls or forced liquidation, higher interest rates and stricter terms, not available through traditional mortgage channels. These products are best suited for sophisticated borrowers who understand volatility risk. C. Asset depletion through imputed income strategies. Some lenders calculate qualifying income based on total assets, including cryptocurrency. How it works: eligible assets are total. The amount is divided over a fixed period, e.g. 60 or 120 months. The result is used as qualifying monthly income. This method is common in non-QM lending, high asset, low-income borrowers, self-employed or irregular income profiles. Crypto is still valued conservatively and must meet verification standards. 3. Documentation required to include crypto in underwriting. Lenders typically require statements from regulated exchanges, transaction history, clear proof of ownership, evidence of seasoning. Stable valuation during underwriting. Transparency and traceability are essential. Current limitations and realities. Despite progress, important limitations remain. Not all lenders accept crypto assets. Standards vary by loan type and lender volatility leads to conservative valuations. Regulatory frameworks continue to evolve. Crypto does not replace credit, income capacity, or underwriting fundamentals. It supplements them. 5. Why this matters for buyers and investors. From a real estate and finance perspective, this shift is meaningful. Advantages: avoids forced liquidation and capital gains, strengthens reserve and net worth profiles, expands access for non-traditional borrowers, preserves long-term asset upside. Disadvantages: limited availability, increased complexity, exposure to market volatility. Conclusion: crypto-inclusive mortgage qualification is not yet standard, but it is no longer theoretical. For the right borrower, digital assets can now serve as a strategic financial tool within certain lending channels, when used carefully and with proper guidance. The future of mortgage lending is becoming more flexible, but it remains risk-managed and conservative. Settings: add bold subtitles with popping effect. Use appropriate media. Use a male clear American voice for the narrator.